We're so happy again that you're with us, because really for the next hour, we're going to be learning about a lot of valuable information. You probably have a lot of questions going on right now with COVID, what to do with your money. Do you keep it in the markets? Do you take it out? There's a lot of things happening in the world that are out of our control, but there are certain things right now with the help of some experts that we can really dive deeper into to make the most of our money. We're going to be learning about what's happening in the marketplace, what's trending, and again, how to best invest right now with COVID-19. So again, I am Kellie DeMarco. Many of you locally might remember me from KCRA. I was the main anchor there for about 9 years. I left the news business after about 20 years and started my media relations agency called Kellie DeMarco Communications. And this is the kind of thing I'm doing now, still using my voice to help people like yourself. I also help people work with the media, help share their message, and really just help you look your best on camera. So we'll give you some contact information at the end if you have any questions for me. But in the meantime, I want to introduce you to our two fantastic panelists. The first is Jeff Spiegel. He's actually joining us live from New York. Hi, Jeff. Good to see you.
Hey, Kellie. Good afternoon and great to be here.
Jeff is the director and head of iShares Megatrend and international ETFs at BlackRock. BlackRock is the largest financial firm in the world with over $7 trillion in assets. Prior to joining BlackRock, Mr. Spiegel was vice president with TLM Realty in New York City. He's also worked in mortgage trading and structuring at JP Morgan and Bear Stearns in London. All right, you probably already know our next panelist, expert here in Sacramento and beyond, Mr. Sanjay Varshney. Hi, Sanjay. You're still on mute.
Hi, Kellie. How are you?
Good. How are you doing?
Good,
Great to see you both. A little background on Sanjay, because I have to brag. Aside from being a friend of mine, he, of course, is founder and principal at Goldenstone Wealth Management. Prior to that, Sanjay was a senior wealth management executive for several years at Wells Fargo Private Bank, and he led the investment strategy for over $200 billion in assets. He's also served as the dean of the business school for Sacramento State for a good chunk of his time, a decade, and he's still a professor of finance there. And of course, he produces the local regional economic forecast, the Sacramento Business Review, which we'll talk about a little later as well. So now that we have that, I want to give you just a couple housekeeping items. We have you all on mute, not because we don't want to hear from you. We absolutely want to hear from you. But in this conversation, as I ask the guys some questions, we just kind of want it to be nice and quiet for them. And then at the end, we want to get to your questions. So certainly, get into that chat box. You can write your questions along the way, and we'll get to as many of those as possible. So most importantly, this is just, it's all about you. And again, we hope that this experience will give you some knowledge as we move forward into the next chapter after 2021 ends. So let's jump in, right? We look back on what a year this has been, 2020. Obviously, a lot has gone wrong. And how do you feel now that it's October? I don't know about you, but I kind of feel like this picture on the left, pure hell. We have to laugh at it, right, guys? You've got to laugh a little. Little Corona extra. I like this guy in the right. He's honestly just happy to get out of the house after all this time. There have been some major issues that have happened over the last 8 months that have no doubt affected your investments. The medical crisis of this global pandemic, millions of infections. Now, I just read this morning, the death rate has topped 1.1 million people worldwide. Of course, we saw the economic crisis with the loss of jobs, people's livelihoods. I know here in Sacramento, a lot of businesses have failed. Restaurant industry, salons, people that really need customers to walk in that front door. Obviously, they're having a really tough time with that. The disruption of the supply chain. As you know, we had trouble getting food and toilet paper at one point. And there has been just so many stresses on the system when we look at the economic aspect. Also, the financial crisis. We saw the market crash in the spring. The airline industry, cruise lines, commercial real estate, it's all been impacted. And then, the human crisis. As a mom, I can certainly relate to this, and I'm sure if you're a parent, the crisis of dealing with what's happening in our kids' schools. I know mine is in distance learning right now, totally online, like what we're doing, which is tough when you're 6 years old. And of course, our kids who are graduating college having a real tough time finding jobs right now. And now, of course, we are in the middle of the election crisis, which has always comes with a little bit of drama. And I know from covering elections for so many years, but those issues have ranged anywhere from, we saw the protests, BLM, looting and violence. We saw the president recently infected with COVID, the Supreme Court appointment, controversy in our mail-in ballots, the stimulus package in limbo. So a lot going on, and it's all affecting our money. So Sanjay, let's start with you here. Give us a little status update on the economy, the markets, and as we end this month of October, right before the election, how are we doing right now?
Thank you, Kelly, and good afternoon, everyone. So this has been a crazy year, just like you said, Kelly. And, I'm in the business of predicting the local economy. I've been doing it for the last 15 plus years. And I can tell you that I could not have predicted any of the stuff that we saw in recent months. And just to recap where we thought we were before all the stuff happened in 2020, and it's still a crazy year, by the way, things are still going wrong. But just to recap where we were, we were enjoying a Goldilocks economy, the longest economic expansion on record that we had seen in history, the lowest unemployment rate ever in the last 75 years at 3.5%, huge equity market run in 2019, NASDAQ was up 38%, S&P 500 was up 27%, China phase one deal had been signed in February, and actually most people, given how great things were all asking the question, when is the next recession? And to be honest, we said there is no recession in 2020. And we could have been, we were so horribly wrong with everything that happened, that followed. In March, you can clearly see how quickly, with the news of the coronavirus spreading, markets crashed 38%. On March 23rd, we defined a new low. Oil collapsed at the same time because both the demand shrank and the supply basically increased. We had the best weeks, the worst weeks in the markets, shelter-in-place mandates. We knew we were going to have a recession. We just didn't know how deep the recession is going to be. And then we saw unemployment claims pile up. Within a few weeks, we saw 45 million claims very quickly on the record. And then a lot of people got so scared, we started equating what we saw to the Great Depression because we had not seen any of this in our lifetime. 15 days where we were trying to figure out what's going on in the markets, felt like an eternity. And like I said, unemployment hit a high of 14.7% very quickly. A lot of people predicted that that's going to go up to maybe 25 or 30%, paralleling what we saw, for example, in the Great Depression era almost 100 years ago, right? Now, obviously, all hell broke loose. But on the flip side, we did see a response, which was very swift, very quick, and between the Federal Reserve and monetary policy and Congress with fiscal policy, we saw literally $10 trillion being put on the table very quickly. And just to give you an idea how much $10 trillion is, our entire US economy is only about 23 trillion. So we're talking about a third of our economy basically being put on the table in terms of money to help everybody, households, businesses, hospitals, the PPP loans, cities, counties, hospitals, they're all basically still lining up and wanting more money. But the response was swift. The last time, literally it took 2 years in 2008, 2009 for the markets to play out the crash. And Congress took more than 500 days to put a stimulus bill on the table. This time, the market crash took place in 16 days and Congress acted fast. Within 4 weeks, we had the stimulus approved and actually in process, right? Now, what we have seen though, is something that is gonna probably stay with us forever. We have seen structural changes that we were not used to. And those who adapted survived and will do probably better going forward. And those who basically did not adapt are probably gonna die. And we have seen all kinds of industries basically react in different ways to the pandemic. How we use office space and commercial space, how we work from home, for example. Initially, we never thought we could do half the things we're doing today from home at that time, right? How we do telemedicine, online shopping, education. You were just talking about your daughter, completely on distance learning. 5-year-olds, 7-year-olds, we never thought in our lifetime they could actually be doing Zoom classes online. Tourism, air travel, restaurants. I mean, you name it. And we're talking about a major disruption to our lives, a major disruption to markets, and a major disruption to the way we basically do business. But here's the good news. The economy is doing way better than most people think, because this is election year. So what you see in the media is probably a lot of hype. You see a lot of noise. But if you cut the noise out and you look at the economic data, the economy came back much faster than anticipated. You can see, for example, there's a lot of really good positive data coming out. In Q1, economy sank 5%. In Q2, it sank about 31.4%. But in Q3, the expectation is we will probably grow 25 to 30% in our economy. Vaccines are in progress. Stock market has already recovered, by the way. So, from the low of March 23rd, the stock market is already up more than 50% from that low. Earnings, season has just begun again for Q3, and they are coming in sensationally. We thought from $170 per share on the S&P 500, we're probably going to see the earnings sink to maybe about 100. Actually, now we have revised the estimates to be maybe closer to about 145 for the year. So that's a very good number, by the way. And you can see, for example, all the companies that are reported so far, not counting Netflix last night, things have been very positive. 65% of the economy, by my estimates, is back to pre-COVID levels. Unemployment is expected to go down to 4% by 2022. This is the Federal Reserve telling you, not me. Right now, the unemployment is about 7.9%. In California, we have a higher unemployment of about 11%. But all expectations are that as jobs get created again, and we basically position ourselves for the new economy, we will see unemployment go down. And then, of course, like I said, this has been the largest digital transformation of our economy, and there are winners and losers. Very quickly, just to show you where we are with the data, unemployment is going down. Retail sales went up 66% quarter over quarter. Consumer confidence has bounced back up. Housing market is doing great, not everywhere. So for example, Sacramento is booming. Why? Because the Bay Area is suffering. Now, because people can work from home, literally, you can see a lot of people basically move to Sacramento from the Bay Area. US GDP is growing, consumer spending is growing. The Purchasing Managers Index, which is our activity for manufacturing and services, is back to pre-COVID levels. So again, great economic activity. The year-to-date market performance has been great. However, if you peel back the onion, the losers and winners, I'll show you the losers, right? Quite a few surprises, because like I said, we expect cruise lines to be hurt, but we did not expect banks to be hurt as much, because this was not a financial crisis. We didn't expect Under Armour, for example, to be hurt as much, but they are, because they're trying to struggle against other retailers. And then who are the winners? Clearly, new economy. Like I said, there's structural changes going on, and these structural changes are going to stay with us going forward. And if you recognize them, we can do well. If you don't recognize them, then obviously it's very hard to make money in this market. So I'm going to stop there, Kelly.
Well, and that's why we need you. We need you to walk us, hold our hand along the way. And by the way, I didn't know that's what WTF stood for. I thought it was something else, but I guess it's what the forecast. All right. Thank you, Sanjay. We're going to check in with you in a minute. So Jeff, considering all of that, what kind of structural or cyclical changes are you seeing based on your insights at BlackRock? You got to unmute yourself real quick. Jeff, can you hear me? Okay, unmute.
And unmuted. It wouldn't be a presentation in 2020 unless someone forgot to unmute themselves. So let me get back to the screen share, but I'll answer the question as we're going. Okay. So I think Sanjay said it really well. We've essentially seen a massive structural shift in what's happening in the world. And at BlackRock, when we're talking about structural opportunities, what we're generally talking about are what we call at the firm megatrends. And megatrends are really the long-term structural transformational forces that are out there changing the world. And so, again, long-term is sort of the key here, but there are moments, kind of sea change moments that happen when suddenly everything moves faster. Even structural opportunities move faster. So when we think about structural, we mean opportunities that play out for 3, 5, 10 years. We would contrast these with cyclical opportunities. Cyclical opportunities play out over weeks, maybe months. And the difference for investors is that when you focus on the structural, you don't have to think quite so much about when you enter and when you exit an investment. When you focus on the cyclical, you can generate performance, but that moment you get in and that moment you get out matter quite a bit. And so that's a really big difference. And megatrends are about the former. They're about long-term opportunities where you spot a theme or a trend and you focus on its adoption. And over the last 100 years, we've seen some pretty amazing trends take shape, and they're happening faster and faster. Just to think about a couple of examples, it took the automobile about 25 years to edge out the horse and buggy almost entirely. It took the television about 12 years to go from 1 in 10,000 American households to 83% of American households. In the early 2000s, so getting into the 21st century, it took only 4 years for Facebook to reach 100 million Americans, or a quarter of the population. And to get back to what Sanjay was talking about, this year that we've had that is so unlike any other has led to even more of that. So Disney Plus, Disney's new streaming service, actually reached well over 50 million Americans in just a few months. And so we've all adopted these new behaviors. And frankly, they were megatrends before. There were long-term shifts already to more internet-connected devices, to more artificial intelligence, to increased needs for cybersecurity, to the value of big data and networks and medical breakthroughs. But some of them have just accelerated tremendously this year. And I think as we go through the discussion, we'll be able to tackle what a few of those are and some of the really compelling opportunities we see that creating for investors.
So Jeff, how would you explain these changes in terms of regulatory, societal, and economic forces or trends?
So when we're thinking about these mega trends, I think the three areas that you just described are exactly what investors might consider focusing on. So the confluence of a regulatory, societal, and economic force together is what can really drive a long-term megatrend opportunity. And we can sort of look at some examples of this, and maybe we'll take it through the lens of electric vehicles. So on the regulatory side, we can really think about demand-driven changes and supply-driven changes. So let's take a demand example. You know, back in 2018, China actually became the #1 EV market in the world. That wasn't because Chinese consumers just woke up one day and said, hey, you know what, we like EVs better now than traditional gas-powered cars. It was because the government changed policy and said that you had to win a lottery, a 1 in 10,000 chance lottery, to buy a gas-powered car, but anyone could go buy an EV. They were trying to reduce pollution. So that regulatory shift entirely changed consumer behavior. On the supply side, take Europe. Starting next year, auto manufacturers there will have to produce 25% less CO2. That means they really have no choice but to produce more electric vehicles. So unless you have regulatory support behind these megatrends, they may not play out. Societal preferences matter too. For the first time, consumers in the US, 80% of them, age 18 to 34, so younger consumers, are actually willing to pay a premium for an electric or a hybrid vehicle. That's a big societal shift in the way consumers want to access green goods. And then economic forces matter too. It's actually the single most expensive component of an electric vehicle is the battery. Battery costs have decreased about 90% over the past decade, meaning that in the very near future, we're actually going to get into a world where it's cheaper on average for an electric vehicle to be manufactured versus a gas-powered car. And at that point, car companies will have to think very seriously about electric vehicles more than they do today if they want to keep offering good value and fair prices to their consumers.
So with all these mega trends, which ones specifically should we be watching for in the future? I mean, these are changing the world.
They absolutely are, and they've been changing the world for a number of years. We actually identified the 5 megatrends that we're showing on the slide here about 3 years ago. And they, again, weren't meant to be a ripple in the pond that we were trying to capture. They are long-term tidal waves and opportunities to really stay invested. And again, even though they're long-term opportunities, they have really accelerated this year. So I'm going to click through these 5: technology, demographics, urbanization, climate change, and emerging global wealth. And Kelly, I'll give you a sense of why we initially focused on this, why we thought of it as a long-term trend, but also where we've seen that acceleration, where 2020 has changed the game and really enhanced opportunity. So we'll start off with this idea of internet connected devices, or the so-called Internet of Things. There were about 30 billion devices connected to the internet at the start of this year. And prior to what we saw this year, that was expected to rise by more than double to 75 billion devices by 2025. And I think it's fair to say that we've undergone the ultimate beta test this year in virtual work and virtual life. And so connectivity has become that much more important. To be clear, none of us would wish to have learned the lessons that we've learned this year, but it doesn't mean we can ignore them. And so 76% of CFOs say that their companies are going to offer more remote work for the long term. 72% of employees expect to work from home 2 days more a week, which is good that those numbers are aligned, or we'd have someone with misaligned expectations. But it's not just actually virtual work that's driving more connectivity. Many of us have tried telemedicine and teleeducation for the very first time this year. All of this is rising this connectivity trend that was well underplay, as you can see from this statistic, to move even faster in the face of what we've experienced this year. The second, demographics, is about aging populations and medical breakthroughs. Pre-crisis, genomics was beginning to enable personalized medicine. You could go to the doctor, have your genome mapped, and get treatments tailored to you. Immunology was changing the game in cancer, stimulating, destimulating our immune systems with immunotherapy. No surprise then, in the face of this crisis, these are also the places providing us hope. RNA vaccines that we're reading about, that's the domain of genomics. Monoclonal antibodies, you were talking about it in terms of President Trump. He was actually given monoclonal antibodies to fight the virus. We've never successfully used these treatments in history, but it looks like we're going to crack them against COVID, ushering in a decade or more of progress, applying them to any number of diseases that have threatened us in the past or will in the future. Then we have infrastructure. We knew trillions of infrastructure spending was coming to support the rise of cities like Delhi and Dhaka, which are going to add 9 million people each in the next decade. And we knew that a lot of this was going to be renewable infrastructure. Governments had already pledged $2 trillion to meet renewables targets. But again, and Sanjay talked about this, with so many people having lost their jobs in this country and around the world, that's accelerating because governments are using stimulus spending to get people back to work. They're fixing those roads and those bridges that have been neglected, preparing cities for those new populations and emerging markets, and building this cleaner, more renewable infrastructure with trillions of dollars deployed. And just the last point, this idea of emerging global wealth, you can see the statistics here. And my favorite one that I talk about in totality is that 44 people escape extreme poverty in India every single minute of every single day. This trend isn't changing. COVID is not going to change the fact that the rise of the middle-class consumer in countries like China and India is a game changer for megatrends and the global economy. And so for us, understanding all of this allows us to offer a range of what we call iShares megatrend ETFs designed to capture exactly these opportunities in your portfolio, ones that we were excited about before this crisis and that have actually accelerated as we seek to fight this virus and continue to stay connected and live our lives.
It's really interesting, Jeff. You just, we think of 2020 as just everything is so negative, but there are really some great opportunities for us as investors, as business owners to jump on board. I have a bunch of friends are saying this is the best year that we've had in business. So certainly if you can recognize some of these trends and do something about it. And that's where Sanjay comes in, because I know, you're watching all these emerging trends. So translate that to us, because, yes, I know technology's up, we're focusing on renewable energy, but where do I go to invest? Like what are places that you recommend that we use these trends to our benefit?
So just along the same lines of the conversation that Jeff was going through in terms of the mega trends. So if you ask the question, where are we today, and how does this basically compare to, let's say, the crash from 2008, 2009? This chart that I have in front of you sort of captures the essence pretty nicely. So in the last crash, the markets were down about 56% from the high, but that played out over 2 years. And then since 2009, we probably saw the most anemic recovery in the United States economy. And not just the United States, I'm talking about the global economy. And even then, in spite of the fact that we had a really anemic recovery, the markets actually went up 400% since the low of March 9, 2009. Once again, markets got disrupted this year, and the crash took place in less than 16 days. So the market was down 33%. Now, the expectation is that we probably have a new bull market that has already begun for several reasons. So just going back for a quick minute to the megatrends that Jeff was talking about, in a lot of ways, we have surprised ourselves by how quickly we have recovered from the losses, both in terms of jobs and economic output, if we were willing to adapt. And those are the structural changes I was talking about, that what we may have thought may happen over the next 5 years with technology, for example, got compressed maybe in a few months. And we have seen that technology change and adaptation accelerate to the extent that we have surprised ourselves that the earnings for many companies, look at the cloud companies, for example, anything that in the technology sector, communication services, right, consumer discretionary, we have seen the market reward those companies that have been able to adapt and been able to grow their revenues in spite of the COVID-19. And then, of course, there are others that were struggling well before COVID-19. So, for example, if I take JCPenney's, I take Kohl's, I take Nordstrom's, they were all struggling well before all this happened. And they will have to basically adapt much better if they want to compete going forward. But if I want to look at the trends, and if we are already 50% higher than the last crash that we just saw in this year in March, and believe me, if I look at the economic data, all the different data points I gave you, unemployment, and you look at, for example, the Purchasing Managers Index, you look at, for example, consumer confidence, you look at the industrial output, literally, it's hard for anybody to argue it's not a V-shaped recovery. What you can argue is whether or not this V-shaped recovery is going to continue, whether it's going to become more like a square root where we level off because there's no further stimulus on the table, or are we at risk of maybe even going down again back into another recession because the COVID-19 situation escalates and we are not able to come out with a vaccine in time, or we don't have the antibodies that basically are effective. So there's a risk out there. But on the flip side, based on the data that we have seen so far, it's an amazing recovery. And I cannot help but being optimistic and being bullish, because if you're not bullish, like I said, look at what happened the last round. If you were waiting for the market to recover, you missed out on the 400% ride. And by the way, this happens every time. I can go back for the last century and show you that every time the market drops more than 30%, you will see that a new bull market emerges. And that's exactly where we think we are right now. Now, we may think based on, for example, stocks like Zoom or stocks like NVIDIA, or maybe some of these other names that we have seen basically making headlines, that, oh, by the way, we have this euphoria and everybody's going crazy. And this is like 1999 and we are partying too hard and there's going to be a huge hangover when all this basically crashes and burns, right? That's not true, actually. If you peel back the onion, you'll find that stock outflows were actually stronger this year than stock inflows. So more money flowed out of the stock market than the amount of money that actually flowed in, which to me is a very reasonable sign that, by the way, we are not over-optimistic or euphoric about the markets, and that you will see the markets actually do better going forward as long as the economy can support it and that we find that the jobs come back in the way we would like to have them come back. Now, it is a low interest rate environment. We understand that. So it's very hard to make money in the bond market right now. Very hard to make money in commodities, especially oil, for example. But in real estate, the same thing. Very hard to make money unless you're in certain pockets. Like I said, there are pockets like ours, which are going up, but there are pockets like the Bay Area and New York that are going down. And in commercial real estate, we have seen huge crises already show up in terms of the stresses, right? So going forward, the stock market, even if you chose not to want to chase the stock market, the question is, what else are you going to chase? And you have very few limited options at this point in time, which explains why you still see people being optimistic. Like I said, we are not euphoric because there's still stock outflows than inflows. But you're going to see volatility. We have a lot of volatility. This is turning out to be a very volatile year. But why are we surprised? I mean, this is 2020. We thought we kicked off the new decade on a very positive note, but everything that can go wrong has gone wrong. And in California, I mean, I can include myself in the power cuts with PG&E. Forget about the raging fires and everything else and the toilet paper crisis, right? when I start seeing power go out, right, I almost get reminded of what a third world country feels like. So I'm not surprised by the volatility. And then, of course, the election crisis obviously is around the corner. We know that there has been a lot of talk, a lot of media hype around it. So all that basically combines into, hey, by the way, where are we right now? Where should we be? So here's where we are. We have had a tremendous run in growth stocks. Like I said, if you peel back the onion, you're going to find that technology that used to be only 17% of the S&P 500 is now almost 30% in terms of the market cap weight in the S&P 500. A few technology stocks are basically carrying the weight. So for example, you look at Apple, Google, Microsoft, Facebook, right, Netflix, they are the largest drivers of what happens to the S&P 500. But the S&P 500 is not doing well across the board. There are many stocks that are still negative for the year, right? So growth has outperformed value, and structural changes that Jeffrey was basically alluding to, they obviously have a huge role to play, and which stocks are going to be the winners and which stocks are going to be the losers. But what we have already seen in the last couple of weeks, the leadership is changing. And we have seen, for example, money come out from the growth sector and flow into more traditional sectors like materials, for example, industrials, even to some extent, banks and utilities. So we are seeing the market broaden out a little bit. But if I have to just pause and say, where are we right now? And where do you think we want to be from an investment standpoint? If I look at the global landscape and I have to put new money to work, I would say I still prefer the United States over Europe and Japan or Latin America or Asia, because the American companies are still much more solid compared to what I'm seeing elsewhere. Within the United States, the stock market is preferred over the bond market and everything else. Why? Because there are many more opportunities in the stock market. Within sectors of the stock market, I still like large caps, but I can tell you that as the economy is climbing out of the recession, mid caps and small caps are going to come into favor. So the next tactical rotation we're going to see is money flow out from large caps and move more into the small cap and the mid cap sector. In terms of the mix of the industries, like I said, technology has been a huge winner. Communication services, right? Consumer discretionary. They will remain winners going forward in my mind, but you will see some broadening out. For example, industrials will be a huge beneficiary of any infrastructure projects going forward. So there will be some broadening out of that, and that's going to obviously dictate how you basically rebalance your portfolios. But if you're asking the question, why are we so optimistic about the stock market, and why does the market keep going up even though there are many other negative factors? Here are a few things very quickly for you. Number one, before the year began, we had $5 trillion sitting on the sidelines in cash. That amount has grown because more people have actually added to that cash pile by taking some money out of the stock market. So we know that when people are looking to place new money to work, that is helping boost stocks. Number two, we have seen a huge consolidation through M&A activity, stock buybacks in the stock market. So we have seen, for example, clearly players are looking for opportunities to basically merge, acquire, take over. And then the biggest factor, in my opinion, as I've been watching the stock market for the last 25, 30 years, 10 years ago, we had over 10,000 publicly traded companies. Today, we have only 3,800 or fewer. So when you have fewer companies to chase with more and more money, that is automatically going to boost many more companies than what would have happened normally, right? Tech, like I said, is basically a large chunk of the S&P 500. And COVID-19, by the way, is not just about losers. New industries are being created. New businesses are basically forming. We have seen the largest spike ever in history in the United States when it comes to new business formation. And that's still going on, by the way, right now. So all those factors combine really well to basically explain why I think the stock market is still well positioned going forward compared to on a relative basis, compared to other asset classes. Not to say that there's not a value proposition to diversification, but I think the stock market still basically has more opportunity.
It's great to hear that. And just there's so many positive pieces of what you're both saying. It makes us hopeful for investments. I can't help but not, ask about the election, because here we are within 2 weeks now, people calling this historic, although I feel like they do every time. Polls right now showing a strong Biden lead, though we know from the last presidential election, some of those early numbers and predictions were way off. So Sanjay, what are the potential impacts of the markets if Biden gets elected versus if Trump gets reelected?
So great question, Kelly. I mean, one of the reasons for the high volatility, and that's going to continue for the next couple of weeks, is the election. And that's the big elephant in the room. We feel we are extremely polarized. We feel that, we are right now at war with each other in many ways when it comes to your ideology and, who you want to support, who you don't want to support. But at the end of the day, if I look at the data, and like I said, the proof is in the pudding. For me, I'm in the game of making good, intelligent decisions and taking the emotion out of the decision-making process, because otherwise I can make so many errors. It's probably going to not be easy. So if I look at the data, October tends to be bad in general, but during election years, it tends to be worse. And then November, December are no worse than any other year, usually. So the elections, basically, the crisis comes around, and then as the certainty becomes pretty clear as to who's going to be in office, who's going to control the House, who's going to control the Senate, who's going to control the presidency, I think the market basically shrugs everything else off and moves ahead. Now, have we seen a contested election before? Because that's the biggest fear right now the market has, that what happens if you don't have a peaceful transition of power, or if there's a re-election, if Trump gets re-elected, but it's basically very messy, and we don't know exactly for sure whether or not he won, right? Well, the last time it happened, if you remember, in the year 2000 with Bush and Al Gore, right? Mm-hmm. And you can see the first few days, the market went down. And then it went down again more, right? And then when there was not a clear victory again, it went down again. Now, if I combine all those three, during that time, the market basically stayed under the 10% loss. In this case, I won't be surprised one bit if, for example, we see the market correct very quickly, 10% or more. Why? Because a 10% correction once a year is normal. We typically see 10% correction every year, and we typically see 5% corrections every year. This year, we've already seen a more than 35% correction, if you want to call that a correction, because in March, like I told you, the stock market crashed. But I won't be surprised one bit, just like the last round. If you remember when Trump, was elected, the Dow futures went down 800 points or more for about a couple of hours. But by the time we woke up the next morning, the market was very positive. So we will see that happen again, regardless of who wins. The market basically is going to react to it negatively, probably, and then it's going to move ahead. Now, as much as we would like to give credit to who's in office for how the economy does and how the markets do, so Clinton can say, hey, during my time, the markets did well. People can blame George Bush and say, during your time, we had a really bad economy. But if you look at the proof in the pudding, in the data, regardless of who's in office, the market's always gone up. So over time, I think, like I said, the market basically shrugs off the uncertainty and simply says, you know what, it's time to move on. And it does, because the market's not pricing in only what's happening with policy in Washington, D.C. The market's also looking at earnings. The market's also looking at the emerging mega trends, like Jeff was pointing out. The market's looking at exactly, how companies can survive going forward and basically help make money in capital markets. And we believe that we are the most capitalistic in the world. And obviously, that's what we expect to see. Now, across the election cycle, if you ask the question, hey, are election years better, worse? You will find that yes, election years tend to be good for the stock market. So right now, for example, we are inching slowly towards closing out the year on a very positive note compared to where we were, for example, with the COVID-19 situation. Midterm elections tend to be horrible for the stock market. So you can see, for example, the lowest return is during the midterm elections. And then, of course, non-election years tend to be even better because there's no uncertainty. So uncertainty has a huge role to play when it comes to how the market performs for that year. But once again, if anybody thought that if the government is divided, is that going to be a good thing or a bad thing? Divided government has always been good for the US stock market. And on occasion, when you see the same party, right, you do see, for example, the market react better. So for example, if I look at the 1-year return during the same party rule, where they control the presidency, the Senate, and the House, the market has performed better. But over a 3-year period, that outperformance basically goes away. So over the long horizon, it doesn't matter. As long as we have a check and balance, we have two political parties that basically try and provide that check and balance to each other, the markets are pretty confident that they can move ahead and do well. Now, new presidents versus incumbents, right? So you can see again here, when a new president is elected, the market still reacts positively. Now, all presidential years, market has been fairly positive. And by the way, if the incumbent president wins, whether you like Trump or not, I'm not going to debate that. But history has shown that if the incumbent basically wins, the market reacts more favorably because there's lesser uncertainty about what to expect going forward. Very quickly, if you ask me, hey, what does the Biden versus Trump really mean on a variety of topics that we believe are going to impact the economy and the markets? And like I said, proof is in the data. As much as we think they have a huge role to play, they don't, because the markets actually move on. But assuming that they do have an impact, what can we expect? Foreign policy and trade. Biden is predictable because he's going to go back to the status quo, whereas Trump has always been very aggressive. He's always been with the America First policy, and we can expect more of that. Taxes. We know under Biden, they're probably going to go up because Trump actually lowered them in the last round. Regulation. We've seen Biden already talk about more regulation. Trump actually deregulated a lot quietly, and nobody actually noticed it. At least the broader market did not notice it. But there was a lot of deregulation that went on in the background. Immigration. Biden is going to be more favorable. Trump, not so much. Inflation and stimulus. Biden is going to be inflationary because we know he's already talking about more stimulus. He's talking about infrastructure packages. He's talking about more money to help the economy. Trump will be forced to do the same. As much as he may think he doesn't want to do it, as much as Republicans have a history of not basically spending too much money and having budget deficits, all that has been proven wrong in the last few years. And finally, the stock market. Like I said, I think both of them will be good for the stock market because there'll be certain industries that will benefit more than others. So in that regard, I think, I would say as much as there's uncertainty about who's going to get into office, eventually, I think the markets will reconcile and move ahead.
Good information there, especially when you compare them side by side like that with just the unknown right now, right? So what does all of this mean for business owners and investors? What do you think the forecast is going to be over the next 12 months?
So it's a great question, Kelly. So markets obviously have a lot of strong players and a lot of weak players too. So because that's how we have a market, right? When it comes to buying and selling on the trade side. However, most people don't recognize that the psychology of investing is actually as critical as the fundamentals. When we talk about earnings, we talk about revenues, we talk about business models, we talk about cash on the balance sheets. My experience has been that investor behavior, more than half the time, is responsible for bad decisions and actually not doing as well as they should. And that's where I think if you were really being rational and you were trying to do it correctly, right? I'm going to show you some data. A lot of people think, hindsight is 20/20. So a lot of people think, I could have easily bought Zoom, but it was trading at $110 per share early in the year, and now it's basically trading at $550. I could have made so much money on Zoom. Hindsight is always 20/20. A lot of people think that they can basically play the same game again and again and time the market perfectly every time, like Jeff was talking about, cyclical changes. You have to get in at the right time, and then you have to get out at the right time if you want to basically make money. And if you're not able to do that consistently, you're not going to make money. If you had stayed invested, many people would probably make a lot more money if they missed 5 days or 15 days of trading in the market, the best days. You can see the return gets slashed by more than half. So the question is, in the next 365 days, how many of us can truly predict the market where it's going to be, in which days to stay invested and which days to basically miss? Time in the market is more critical than basically how much you have in the market. The longer horizon you have, the compounding basically comes out in your favor. And a lot of people, once again, make the mistake of staying in cash for the longest time. They don't want to be participants in the markets because they get afraid. You have to be invested. You may make mistakes, but you got to be very assured that over the long horizon, you're going to come out ahead. You got to be a little contrarian. You got to make sure that you're not basically participating in a herd mentality. You have to be disciplined. You got to make sure that you're doing everything, based on logic and not just allow your emotions to overcome you. Now, here's another reason why a lot of the average investors basically do poorly in the market. There are a couple of reasons, in my opinion. One, they basically are doing it themselves. They are trying to do everything themselves. In my opinion, that's a mistake. Why? Because I cannot be my own cardiologist. I cannot be my own dentist. And I cannot also be my own financial planner and the investment guru, because there's not enough hours in the day for me to do all those three things. But a lot of people somehow think the stock market is an easy game. Let me just do it myself. I don't want to pay the fee. So guess what happens? Many people are indexed. They're playing the average index funds. To a large extent, if you're indexed, you cannot beat the indexes after you pay the fee. I mean, that's the downside. So you will basically have average performance. You're not going to get the winners that I showed you earlier on the slide, like a Netflix or a Zoom or some of these other stocks, because they're a very small fraction of those index funds, right? So you got to make sure that you're more active. As much as people tell you that be passive, and if you can't beat them, join them. My philosophy is all the multi-billionaires in the world and the people who make money on Wall Street are not playing the indexing game only. They're not basically leaving the money in average kind of performance. They're not going to basically become rich doing that. So a lot of this stuff, basically, like I said, is about being very disciplined, making sure that you're doing the right things, and being very focused on what the future is likely to bring you.
Sanjay, thank you so much. Jeff, thank you as well. We're getting some great questions in as you're speaking about, what to do next. And we, again, ask you to get in the chat box here and write your questions, and we'll try to get to them. Let's start with this one, Jeff, to you. What happens to the megatrends after a COVID vaccine is discovered?
I guess there are a wide range of megatrends, so it depends on the megatrend. The most directly relevant is obviously going to be that demographics and social change megatrend, and specifically genomics and immunology, which is represented through our iDNA ETF. And as I sort of mentioned before, the run up in that strategy, up over 40% this year, we actually don't see as a play on the vaccine itself. A number of the leading companies, Moderna and others, have basically already said they will license out their vaccine to their competitors at no cost. So I don't think a lot of these companies are actually going to be making money from the production of the vaccine or from the production of the therapeutic. Rather, I think the opportunity is the breakthroughs that Moderna is having in RNA vaccines, that a company like Regeneron is having in monoclonal antibodies, then open up a new window in the longer term, hopefully after COVID, in applying these new techniques that have gotten hundreds of millions and billions of dollars of research support this year to other areas. So I really see it as a long-term play. Once we get this vaccine, these companies can actually start working towards applying it to other areas, which is how they're actually going to make profits from it.
Okay. Thank you, Jeff. We have a question from our audience about retirement. Maybe for you best, Sanjay. This one says, should I change my portfolio based on my expected retirement date from 60-40? And that was one of the first questions that we had up top. It looks like Dana has allocation of 60% stocks, 40% bonds. What do you think?
It's a great question. So I'm going to go back to my comments I made about the index funds. The index funds are a very passive average strategy, not knowing who you are or what your personal circumstances might be. So if you don't know anything different, you basically buy that canned formula and you say, okay, I'm going to basically do that average formula. Now, 60-40 formula has been thrown out there as an average formula, not knowing your personal circumstances, Dana, for example. Now, if let's say you truly need that portfolio fairly quickly in the next 5 years, and you're going to draw it down for your living expenses, for your retirement, it makes sense to be more conservative because the stock market can be all over the board in the next 5 years. And you can actually keep your portfolio more stable by having an allocation to fixed income assets, real estate, commodities, and something else that basically may be counter-cyclical to stocks. But on the flip side, if you're not looking to draw down the portfolio for the next 5-10 years, then the 60-40 formula is hurting you because you are basically leaving more money on the table by buying into a canned formula that is not supposed to work for you. I mean, you have different circumstances. A lot of people who create wealth very quickly, and let's say you create tremendous wealth in your lifetime, chances are you're going to leave that behind as a legacy portfolio for your kids. You will never draw down that portfolio in your lifetime. So in that context, you should never be, for example, in a 60-40, 80-20 kind of deal, because you can take a lot more risk, and you can actually be a lot more equity biased than someone who basically needs to use that money over the next several years.
Yeah, I know, getting into your 60s, you're really trying to, figure it out, ask questions, because that's kind of, crunch time for a lot of folks, which is, I know, something that you really do well in, Sanjay. Another question that we got from David, he says, given the financial or fiscal taxation plans are significantly different between the presidential candidates, will this favorable trajectory for low-income families continue with the election of either candidate?
So yes, in the short run, yes. But I think I want to remind ourselves that tax rates have been higher before in our history in the United States. And we have seen, for example, the markets do well in spite of high tax rates. And that includes capital gains, not just income tax rates, right? The question I think we have going forward is that given the structural deficits that we have on the table, and we have a broken system when it comes to, for example, the Medicare and Social Security, because both of them are going negative starting 2021. I'm not sure how much tax increases can truly save us from the day of reckoning, which is going to happen someday, because we are slowly headed in that direction where we cannot solve all the problems by simply basically taxing people, to death. So I think, and keep in mind, in California, we don't know it, but I can tell you the numbers because I saw it when I was on the other side of the fence. We have seen net negative migration for the last 2 years, a flight away from California by the top 1% incomes in the state. They're calling Nevada home, they're calling Arizona home. So we see those short-term disruptions where tax increases will cause people to basically do other things, to find loopholes, et cetera. But in the long run, like I said, I'm still optimistic that we have gone through situations where high tax rates did not really truly hurt the capital markets.
One more question here, and I think, even though it's about stocks, I think, Jeff, you could chime in here too. This is from Mark. He asked, do you see any comeback stocks as COVID subsides? Think, airlines, Boeing, cruise lines, as people get back out and about. And I think that, let's talk about it from a stock perspective, but also from a trend perspective. Let's start with you, Sanjay.
Okay. So for me, absolutely. I mean, you will see that the industries that got hit the hardest, leisure and hospitality, travel and tourism, they're being forced to adapt, by the way. They are being really forced to rethink how they can basically come out of this mess. And in some cases, they may not go back to pre-COVID revenues anytime soon. But on the flip side, we will see a spike. And we have seen, for example, on days the stimulus looks promising for airline stocks get a spike. So we will see stronger spikes as the COVID-19 situation resolves itself. Many of those company stocks, will basically find better days ahead. That includes the Disneys of the world, because, right now Disney is still under pressure. They're trying to adapt, with more streaming services, for example. But I do expect even traditional industries and stocks that have been beat up by COVID-19 to have a play going forward. Yeah.
And that's going to have a big play on trends, Jeff.
Yeah, and I would say maybe 3 of those trends that I'll hit on rather than single stocks, but you can identify stocks associated with these, or certainly take a look inside some of the ETFs I'm going to reference. So one is going to be automobiles, and we're already starting to see this. And I think early data in China is a really strong leading indicator. As the world is opening back up, people are not willing to take mass transit the way they used to. And so automobile sales in China have spiked through the roof. As a result, we're starting to see that in the data in the US. If you combine that with what we expect is going to be significant digital infrastructure, including charging infrastructure, put into place as part of stimulus spending around the world, we see electric vehicles as a major opportunity for both of those reasons. That's represented in IDRV, our self-driving and electric vehicle ETF. And the other area I would point to is actually around certain emerging market economies. So I think investors have had a lot of questions around the ability of countries like India to manage the scale of this pandemic, and certainly questioned the data that's coming out, not in any deceptive sense, but just in a country that large and diffuse, how much do they have a sense of the virus's toll? So I think there's been a really pushback against that. But as we get through the virus, countries like India are going to resume their growth. That is driven by sort of amazing demographic factors and the rise of the middle class. And so I think there's a value opportunity at the moment in how beaten down countries like India and their stock markets have become.
Great insight, Jeff, Sanjay. Thank you both so much for your time and making things a little bit easier to understand. I think some takeaways that I got from this, certainly the future is optimistic as we've seen, this new business formation. The markets and economy are going to do well next year. That's great to hear that, but there's going to be some winners and losers. And then also, I think, just looking at the new industries, the new trends that are going to require more financial expertise to really pick the right stock and the right company. So we really appreciate your time with this. And we saw a question earlier if these slides are going to be available. Yes, they will. Jeff and Sanjay will share this slide deck with you. That will be available to you on their website. We also recorded this, and we're going to put that on the Goldenstone Wealth Management website. And of course, once you're on the website, you take a little look around. If you have any questions about your investments, low-cost 401k plans, just being a winner, getting some advice from these guys that really know what they're doing here. That's a great time to just give them a call. And we know we couldn't get to all your questions, but certainly feel free to email any of us and let us know anything that we can help you with. And then just a quick reminder again that Sanjay will be doing the Sacramento Business Forecast in January with the Sacramento Business Journal. And so we'd love to have you join for that as well. Gentlemen, really appreciate your time this afternoon and giving us a little bit of hope in what has been such a crazy year of 2020, but really good insight and things that we can kind of hold on to as we invest our money and keep it in the markets. Thank you so much.
Thanks for having us, Kellie.
Thank you, Kellie.
Everyone have a great day.